Dipan Mehta then on the show with us. Dipan, hi, morning. Good to have you on the show. Just wanted to understand what is it making of the market, because while large caps have come back, there's a lot of sectoral churn as well. One day it's autos, one day it's metals, one day it's Reliance and L&T.
Yeah, good morning. Thank you for having me on your show. I think this is exactly the characteristics of the bull market, and that's the reason why we are not seeing any major correction in broad market indices. Because if one or two sectors are lagging or correcting, then there are other two, three sectors which are stepping up and covering those losses, and therefore we are seeing the markets nicely scale in a very gentle manner to higher and higher levels. Now, a few weeks ago, the private sector banks were, kind of in a correction zone, not a few weeks, for several months. And now they have taken the mantle. Sometimes Reliance does the trick, and then the technology stocks from time to time also become the flavor of the market. Day before yesterday, it was auto. So this sector churn is something which is very normal in a bull market. And that's what, keeps the investors interested, because although the portfolios may not be doing as well, the broad market and the top and the major indices, they still show a lot of strength.
Your strategy, last time when we spoke, you did mention, Dipan, that you raised some cash, you sold at the higher levels, but that was like a 3-week old conversation. World has changed in 3 weeks.
Yeah, good. So we are still sitting on cash.
These days the rally is so unbelievable, even the decline and the uptick. Everything is getting so concentrated that it's only you realize in hindsight, oh, I wish I would have not sold. Oh, I wish I would have bought more. I wish I would have not waited.
See, Nico, it's all right. I mean, it's not that we have sold off completely. For that matter, no professional investor goes 100% into cash. Max cash levels typically in a portfolio are 15, 20, 25% or so. But the kind of interest and the stocks you buy also make a difference. If they are doing well, then at least you're not lagging your indices or whatever your benchmarks are. But more important thing is, the question is, you're sitting on cash. What do you want to do about it? You want to buy at these levels? And that's a big question mark, because all the good quality businesses are trading at extremely expensive P multiples. And I've seen this in the past, and actually it has happened in portfolios that we are managing, that you buy something which is at an expensive valuation and you hold for 3, 5 years also, and still the returns do not come through. So I feel that it's important to buy a stock at reasonable valuations, and there should be some margin of safety, because if something goes wrong, then the correction can be quite brutal.
Vishali, a couple of stocks which had an interesting session yesterday, and one of them actually is SBI Cards. This was like the hero pedestal stock of 2020 to 122. Everybody just thought Indians will grow, they will use more credit cards, go and buy SBI. The stock has been an underperformer. Yesterday's price action in SBI Cards, that impressive, Vishali.
Very good morning to all of you. Yes, so surprisingly, after a very long time, we saw an up move coming in SBI card. So I would say, one can take it as a trading strategy, because the way we are seeing the candle formation, especially yesterday and with high volume, I think the stock is ready. It can go towards 780 level, and I think 720 would act as a good support level. So I would not think much of it, but for now, 780 would be my target.
Meantime, Dipan, curious to get in your take on the re-rating for HDFC Bank. Bernstein saying that better communication can lead to a re-rating. It would be important to address investor complaints in Q4. Is that the strategy or the road ahead or the silver lining maybe for an HDFC Bank? What's your view?
See, HDFC Bank is trading at P multiple price to books, which are at historic lows, I would say. I've never seen HDFC or ICICI or Kotak Bank trade at these multiples. No doubt, the growth rates certainly have come off, but even then, I think the correction in valuations is even higher than that. And I was very impressed with the numbers which came through for the fourth quarter. The bank is focusing a lot on deposits, which is very important, because that's the strength of HDFC Bank, and that's how it's able to ride through so many crises, because its resources are pretty much intact. And I feel that the stock price has turned around, as has the bank. This quarter, keep our fingers crossed for a very good set of numbers from HDFC Bank, and all future quarters also should be quite impressive. From that point of view, if you're positive on India, then you have to be positive on HDFC Bank. It's the largest, amongst the largest banks, the top two banks in the country. And with so much of demand for coming in for credit from so many sectors, right, from housing, automobiles, capital goods, and so many other sectors, it's very difficult to make out a case for the top banks like HDFC, ICICI, or Kotak underperforming for an extended period.
Short while ago, remember we spoke with Atul Chaturvedi of Sri Renuka Sugars, and he was talking about the welcome move of the government directing more sugar to ethanol. Just wondering, Dipan, what your take is on this news? Any, commodity plays or sugar stocks that you would look at closely?
Well, I think this year, not the sugar stocks as much as I think capital goods manufacturing companies servicing the sugar sector and ethanol like Praj Industries, Triveni Engineering. I think they certainly merit a mention. And there was some uncertainty when the government made regulations preventing sugar companies from using certain types of sugarcane for ethanol production, and that caused the stock price to correct as well. But I think both these companies are doing exceptionally well. They are sitting on decent order book position. And India and globally, more important globally, we are going to see higher and higher ethanol capacities coming into play, not just using sugarcane as feedstock, but also a lot of other agro products and agro waste as well. So if you have a long-term view, I think we're very positive on both companies. They are market leaders in their own space. And Praj in particular has certain technological edge as well. It's trading at, I would say, both companies are trading at high P multiples, but I think at corrections, we make a good investment case.
Dipan has a very, very basic strategy. We can divide the market in two, pre-election, post-election. As an investor, how would you approach the pre-election time, which is where we are right now, and the post-election time, which will be applicable 2 months from now?
See, I think that there'll be opportunities post-election because this kind of market cannot sustain. It has to be a correction. And right now, I think a lot of buying is taking place in anticipation of very good performance coming from the BJP and the NDA. And we have seen this sell on news syndrome in the past markets. And I think that's something which can play out once the results are out, because all the good news would then be in the price, and this big uncertainty, however big it may be, is over and done with, because by and large it's going to be status quo. I mean, it's going to be the same ministers, the same government policies, and the same kind of government encouragement or whatever steps they are taking. It's going to be more of the same. Not that much is going to change, but it's just that investors have that feel good factor if the BJP or the NDA wins with a larger majority than they have in 2019. But as I said, I think let's be a bit aware of this sell on news syndrome that can be quite severe. In my opinion, opportunities to buy should come just before the election or even after the elections also.
There's some brokerage notes this morning on stocks within the real estate space. MOSL on Kolte Patil, they've initiated a buy saying profitability will improve, but with lag. Jefferies has got their latest note coming out on Godrej Properties saying that it's a buy rating. There could be a surge in sales for FY24. Momentum is only going to continue. And by and large, Dipan, it's been a fairly optimistic view after the run-up that we've seen within real estate. Are you optimistic here?
Well, I'm surprised with the numbers coming through from all the real estate companies, even Godrej Properties. And, they are consistently having fantastic sales figures, collection figures. I've never seen the balance sheets in such better scale. And what is more important is that we value these companies on a net asset value basis, not a P multiple. And although a lot of these companies are trading at or slightly below the net asset value, the surprising thing is quarter after quarter, there are so many projects, be it joint redevelopment or a land bank, which they have earlier. So they're adding so much of net asset value quarter after quarter that the values keep on going up. Now, this is a very tricky sector because, you could have a few soft few months or so, and base effect also will catch up. So while I would prefer to remain invested in all real estate companies, including Godrej Properties, and by the way, disclosure, we are invested in Godrej Properties, I just feel that maybe a correction, 15, 20, 25, 30% type of a correction may make a good entry point and provide some margin of safety.
Dipan, I don't know noticed it, but we've been discussing on ET now that how the Birla Group or AV Birla Group has suddenly become aggressive. They've entered in the business. They are demerging Aditya Birla Financials, Aditya Birla Retail, I beg your pardon. They're looking at listing of Novelis separately. They're moving into jewelry business. It just reminds me of, let's say, what Tata's did in 2020 and 21 and what Mahindra's have done in 21 and 22. They looked at all the businesses, checked on the capital allocation and reinvented themselves. Could Birla Group and can Birla Group of companies be the dark horse of 2024 and beyond?
Yeah, Nikunj, your observation is pretty insightful, I would say. And certainly when so many actions do take place, the group certainly starts to do much better, as we have seen in what you named Tata and Mahindra Group. And the timing also is right to do these kind of corporate actions because the street, loves all this demerger and value unlocking. And certainly they can raise a lot of capital also in the companies where capital is required. So from that point of view, I think it's a move much needed. But broadly, I think all of the positives have been captured. Although Aditya Birla Finance is an interesting proposition because it's trading at a discount to some of the larger companies like say Bajaj or Cholamandalam, and it's a top-class NBFC. They have survived many ups and downs. Have been around for a long, long time. So when I look at the entire picture, I prefer that company over some of the other group companies. Ultratech, of course, is in a different zone altogether, but our view on cement is bearish. So, we would like to just, remain invested or stay underweight over there. And the retail companies are still quite expensive. And Grasim, as you said, which is going into paints, that's more of a longer term story. And, problem with Grasim is that it is getting a valuation of a holding company. And typically we don't like to buy holding companies.
Acquisition, Dipan. We've spoken about names from the bank space. We've spoken a lot about fintech, but haven't discussed anything what you've purchased or increased your allocation in last month or so.
Nothing, absolutely. So we are just staying put. Just come back from a long holiday, only to be surprised at where the markets are. And as I said, our view is cautious, and I don't want to buy anything so expensive at these levels. Waiting for a correction. If it doesn't happen sooner, it will happen later, I think.
Cautious. You think earnings are about to could peak out, or in general there will be a macro concern around the corner? When you say cautious, is it based on valuations or is it based on something at a macro level?
I think the earnings will have the full effect of base, and that will be a very important aspect. So I don't think that the quarterly earnings March quarter will be as good as the street is expecting. There could be a few outliers. I think auto may do well, but a broad basket of stocks, I think, will tend to disappoint and cause a lot of stock-wise, stock-specific volatility. And, valuations are just, I cannot but keep on saying it again and again, that, price to earnings growth, typically what you would call a good company to buy at around 2.5 times, are typically in the range of 3, 4, even 5 times or so. And while there are a few low PE stocks, then those businesses also are not that great. There's high earnings volatility over there. So when you want to look at a business where there is solid earnings growth on a long-term basis, those are all quite expensive. And you could have a miss or two in their quarterly earnings, and that could cause a sharp correction in those stocks. So those are the kind of situations we are waiting for to put our money to work. But for the time being, I think, as I said, this earnings season may not be as good as the street is expecting. And that may provide opportunities for long-term investors like us.
All right. Good to have you on board. Thanks so much for joining in with your take.
If you like this video, then like, share and subscribe to ET Now.